So you did it. You signed on the dotted line for that 30-year mortgage, thinking you knew the deal. You saw the big number, the interest rate, and that one single fixed monthly payment stretching out for the next 3 decades. A silent player the banks are betting on, but one that's almost never mentioned in the brochure. That partner is inflation, and it is secretly, relentlessly, and profoundly changing the entire game. You saw safety, predictability. It's about how the very nature of money clashes with long term debt. For most of us, buying a home is the biggest financial decision we'll ever make, and the star of that show is the 30-year fixed rate mortgage. The illusion is that the numbers on your loan documents are fixed in stone, that a dollar is a dollar, and the 2000 you pay this month is the exact same as the 2000 you'll pay in 2045. Every month you take a pickaxe, that's your monthly payment, and you chip away a piece of the block. That's the nominal view. It's the single most important financial concept that almost nobody talks about when you get a loan. Back then, that $150 was a huge piece of their income. Today, it's less than a couple of streaming subscriptions. They weren't financial wizards. They were just sitting on a fixed rate loan during decades of steady inflation. The bank showed them the pickaxe, but nobody pointed out the heat lamp. You and the bank are betting against each other on the future of inflation. If actual inflation over the next 30 years ends up being higher than their built in premium, you win. Big time, you're wiping out your debt in real terms. But if inflation comes in lower than their prediction, the bank wins. They've essentially overcharged you for a risk that never fully showed up. Inflation eats away at the purchasing power of money. The dollar you earn today buys more than the dollar you learn in 10 years. They often sold with these really low teaser rates that look like an amazing deal. The fact that inflation melts away your fixed rate debt isn't just a cool piece of trivia. It's the key to rewriting your entire financial plan. Most of us are taught to hate debt and worship savings. But here's the thing, inflation punishes the saver, and in the right circumstances, it rewards the smart borrower. A recent study found that while 75% of people know inflation eats their savings, only about a third of people understand that it also eats away their debt. That knowledge gap is where financial power is won and lost. But what's not always shouted from the rooftops is that with an arm, the bank has just passed almost all of the inflation risk from their books onto your shoulders. The best way to make your fixed rate loan work for you is to make sure your income grows over time, hopefully faster than inflation. And look, paying off high interest credit cards is always smart, but aggressively attacking a low fixed rate mortgage when inflation is present can be a huge strategic error. You're just using the same tools the big guys use, but for your own benefit. Why would you rush to pay off a loan that's shrinking on its own, using today's valuable dollars, when you could use that money to invest in things like stocks or other assets that can grow faster than inflation? Your 3% mortgage isn't really a liability when inflation is at 3.5%. It's a source of incredibly cheap leverage. It's an asset. The banks don't necessarily hide this in some evil conspiratorial plot. Their system is just built to price it, manage it, and thanks to inflation, it's a bet that is tilted in your favor. By understanding how this all works, you're no longer just a character in that story. You get to be the author, so don't just pay your mortgage, understand it, master it, and use it to build your future. Your mortgage is the very tool that lets you pay for today's expensive asset with tomorrow's cheaper money and present information in a way that naturally hides its true effect on you. They rely on you focusing on the monthly pain of the payment without seeing the long-term gain of your fixed debt. Every raise you get makes that fixed mortgage payment a smaller and smaller slice of your monthly paycheck. Your housing cost gets easier to handle, which frees up your money for other investments. This is so much more powerful than just aggressively trying to pay down the mortgage. Has this changed how you look at your own mortgage or other debts? Drop your thoughts and questions in the comments below. I promise I read them. And if you want to go deeper on strategies for building wealth in this crazy financial world, make sure you subscribe and hit that notification bell so you don't miss what is coming next. And most importantly, the dollar you owe today is worth more than the dollar you will pay back in 10 years. It is one of the greatest wealth building tools available to an everyday person, and then ignore it for 30 years. It's to actively manage it. When interest rates take a dive, refinancing can be a game changer, but it's not just about getting a lower payment. It might be about shortening the loan term or even pulling cash out to invest somewhere else. If you have a smart long-term plan, we've been shown those scary amortization schedules, focusing on the massive pile of interest we'll pay over 30 years. But that story leaves out the main character, inflation. The key is to see your mortgage as a dynamic piece of your financial life, not a static 30-year prison sentence. You have locked in the price of the biggest purchase of your life for 3 decades. Every single year that inflation does its thing, the real cost of your housing goes down. Your payment is a fixed number, but the value of that number shrinks. If this is making the gears turn and you restarting to see your own finances a little differently, do me a quick favor and hit that like button. You took out that loan to buy a real asset, your house. While the real value of your debt is getting eroded by inflation, the nominal dollar value of your house is typically being pushed up by that very same inflation. Let that sink in. Your biggest liability is shrinking in real value while your biggest asset is growing in value. It's like being on an escalator going up while the ball and chain on your ankle gets lighter with every single step. It's just one click for you, but it tells the YouTube algorithm that this is valuable information and helps get it out to more people who really need to hear this. Is it fixed for the whole 30 years? Or is it an arm? If it's variable, you need to know everything about it. When the rate changes, what it's tied to, and how high it can possibly go. If you have a variable rate loan, your number one priority in most markets should be to refinance into a boring, long-term, fixed rate loan. Take the inflation risk off your shoulders and hand it back to the bank where it belongs. Now, let's talk about how you can take this knowledge and flip the script. A variable rate loan is like agreeing to pay whatever the supermarket decides to charge every single year for 30 years. When the economy gets hot and central banks raise interest rates to fight inflation, an arm is a direct punch to the gut. Your rate adjusts upward and your monthly payment can explode, sometimes to a point where people can't afford it anymore, leading to default. We all saw how that movie ended back in 2008. This is called real debt erosion. For anyone with a long-term, fixed-rate loan, inflation is systematically reducing the real burden of their debt. But what they'll never show you is a real amortization schedule, one that factors in a projected rate of inflation. Why not? Because it would tell a radically different story. It would show the real weight of your debt getting lighter and lighter over time. You'd probably be a lot less anxious about the total amount, and maybe you'd think twice about paying it off so aggressively. The focus is always on the huge, terrifying nominal interest you'll pay, not the real inflation-adjusted cost of the loan, which is much, much harder for the average person to figure out. You are repaying your loan with progressively cheaper money. Now let's add inflation. Inflation is like a slow, invisible heat lamp aimed at that entire block of ice, 24/7. While you're busy chipping away with your pickaxe, that heat lamp is constantly melting the entire block, reducing its real size. You're paying off a debt that is shrinking all by itself. They can't be that dumb. And you're right, they're not dumb. Banks are masters at pricing risk, and the biggest risk to a lender over 30 years is the very same inflation that helps you. So how do they protect themselves? This is where the whole setup gets really clever. It's not even close. It's held up as the gold standard of borrowing. That's just the face value of money, the number on the bill. They'll show you page after page of amortization schedules detailing every single nominal dollar of interest you'll pay over 360 months. It's a huge, intimidating number. It's meant to show you the cost, but it conveniently ignores the changing value of that cost. Hidden inside your seemingly simple fixed interest rate is something called an inflation premium. When a bank gives you a 30-year loan at 6%, that rate isn't just pulled out of thin air. It's made up of their cost to get the money, their profit margin, a bit extra for your credit risk, and the big one, that inflation premium. They are making an educated guess on what the average inflation will be for the next 30 years. And they are charging you for that guess, starting now. You are literally prepaying the bank to protect them from the very thing that could help you. And this premium is never listed as a line item on your statement. It's just baked right into the rate. Why? Because it feels stable. Your payment today is the same as it'll be in year 15 and the same as your very last payment in year 30. In a chaotic world that feels like a rock, it is the story of how the system that is meant to give you stability is also designed to benefit the lender in ways most of us never even think about. But what if I told you that there's a hidden partner in your loan? This isn't some wild conspiracy theory. It's actually much simpler and more important than that. By the end of this, you'll look at your mortgage statement, your student loan, or your business loan in a completely new way. You won't just see a debt you have to pay down. You'll see an economic tug of war, and you'll finally understand how to start pulling the rope back in your direction. Section 1. The Problem, the Illusion. Of the fixed rate world, let's go back to the moment you signed those papers. But here's the catch. That rock is sitting on shifting sand. Loan documents and the banking industry almost always focus on what they call nominal values. Think about it like this. Imagine your loan is a giant 10-ton block of ice. This is the concept of real versus nominal value. Have you ever heard your parents or grandparents say they bought their first house for $30,000 and the mortgage was just $150 a month? Section 2. Agitate how the game is played right now. You might be thinking, okay, if inflation helps me, then aren't the banks losing? They protect themselves by making you pay for that risk from day one. This makes every fixed rate loan a kind of bet. But this is where it gets really interesting. Look at variable rate loans or ARMs. A fixed rate loan is like agreeing on a set price for your groceries for the next 30 years. The way loans are presented makes this even murkier. Banks give you that amortization schedule, a sea of numbers in nominal dollars. Okay, we've laid out the problem. Section 3. The solution: turning the tables and using debt as a tool. Understanding all this isn't about getting mad. It's about getting smart. So, how do you use this? First, you have to start seeing your 30-year fixed rate mortgage not as a life sentence but as a powerful financial asset. And here's the other half of the magic formula: asset appreciation. With this new way of thinking, here are the moves you can make. 1. Know your weapon. First things first, know exactly what kind of loan you have to. Focus on growing your income, not just prepaying. 3. Rethink paying off good debt early. The old advice says to become debt free at all costs, throwing every spare dollar at your mortgage. 4. Be a strategic refinancer. The goal isn't just to get a mortgage. When you adopt this mindset, you stop being a passive person in debt and become an active manager of your own money. Conclusion: for decades, we've been sold a simple story about debt. It's bad and you should get rid of it as fast as possible. Inflation is the twist in the plot. It's the hidden force that changes everything, quietly working in the background to reduce the real value of what you owe. But now you know that a long-term fixed rate loan is more than just a debt. It's a 30-year bet on the future value of money. The story of your loan isn't just about paying for a house. It's the story of a long, slow, and powerful transfer of wealth. What do you think?